Joining us live from the Chicago Board Options Exchange is Jamie Tyrrell of Group 1 Trading. He actively trades VIX options. We are also going to speak with Michael Vogelzang. He helps oversee $1.6 billion in assets, the Chief Investment Officer at Boston Advisors. But I want to get to Jamie first. Just now, about 2 minutes, Jamie, away from the close. I was thinking this weekend, will volume ever pick up ever again? And then I thought to myself, probably not. But what's your take on that? I mean, do you think that we're ever going to get back to the good old days where you actually see on a regular basis 9-10 billion shares traded across the country?
Well, I think volume tends to pick up when something changed, specifically a big move in the S&P 500. And over September, although it was a very strong month for the S&P 500, it was a pretty blah move up, just about 0.5% a day every trading session. So if we see a big 3 or 4 or 5% move one day, I think that's really what we'd need to fire up volume.
I want to point out that we're only seeing about 6 billion shares right now, which is obviously very low. Okay,
right.
We still have a minute and a half left in trading.
Michael Vogelzang, do you care that there's no volume?
You know, not a whole lot. I care about basically some things that we're more worried about long-term sentiment, and I think volume is actually just a proxy for long-term investment sentiment. Things have been lousy for a decade. It doesn't surprise us that volume's down a little bit. We think volume will pick up when markets pick up.
You know, guys, one of the things that we talk about all the time about this volume thing was, in the summertime, volumes seem to spike on those down days, but seem to kind of just be anemic on the up days. Here's a situation where we have a little bit a different situation, right? Volume anemic on both sides of the equation, on upsides or downsides. So, Jamie, from your perspective in the pits down there, is it going to be, is it a change in sentiment here? Do people not fear the downside as much anymore?
Well, I would say first that a lack in volume isn't necessarily a negative sentiment at all. But what we've been seeing over the last couple months is really just a reduction in volatility after the flash crash that really hasn't necessitated as much trading. So when you see a big down day or big up day, you're going to have a lot of high frequency trading. You're going to have a lot of trading here in the pit. And without much movement, we're just not seeing that.
Zara just talking about some job cuts. Friday, obviously a key focal point with that monthly jobs report. Michael, is that going to be a game changer potentially for market sentiment in your view?
Well, if it's an extreme, if things come in worse and/or significantly better than expected, it might be. But I don't think a whole lot's been going on in the last month to make a significant difference there. We're really focused on what's going to happen with earnings. We think earnings are going to be, September probably discounted a pretty good earnings season already, so we're a bit worried. But that's really where our attention is right now.
Hey, Michael, it's Adam. Speaking of jobs, obviously you got to look at the job losses and the layoffs at places like D.E. Shaw, Knight Trading, Bank of America, et cetera, et cetera. Is this just the tip of the iceberg, Wall Street layoffs?
Well, I think so. I mean, we'll see. I mean, it's tough to know. Our business has not gotten back to where it was before the crash, clearly. And I think there's some rationalization in the general sizing of Wall Street still happening. It wouldn't surprise us if we see some more of that. I think you're talking about, I don't know about the tip of the iceberg, but maybe the middle slice.
Michael, when you talk about layoffs on Wall Street, you have to think about earnings from the financials. That's the group that's expected to see the biggest increase in earnings in the quarter. This, even though we've had a lot of downgrades to earnings estimates. So do you think we're going to see some disappointments there, especially with these volumes anemic like we've been talking about? Well,
the volumes aren't going to help. I think more importantly, it's really a question of whether investor expectations have been sort of met with Wall Street. For the last year or so, most financial firms have been beating Wall Street estimates, the earnings estimates from Wall Street analysts. And, I think they're finally now catching up. Now, all of a sudden, we've got a bit of a slower economic environment. And so we may see some disappointments. It wouldn't surprise us. But, these companies are doing a lot better than they were 18 months ago. And that's really, I think, what the most important thing is. We're expecting and hopefully hoping to see some dividend increases out of some of the big names sometime in the next 6 months to a year. That's really the missing piece, we think, in terms of shareholder value.
What are your earnings expectations, Michael? Because we have a story out today that the street is downgrading S&P earnings forecasts. And we've been hearing from a lot of individual guests for a while that they have to come down both for this year and next year.
Right. Again, it's this odd dynamic of Wall Street getting, being behind for the whole year, finally now getting ahead, and it looks like they've gotten a bit ahead of the what we expect for this quarter and potentially next. So there's going to be some softness in earnings estimates, we believe. We're also in a very difficult period right now. We've got this week, sort of last week, this week, where there's really a vacuum of good news, and all we really hear about are companies that are going to tell us that they're not going to make their estimates. And so this is sort of a dangerous couple of weeks here. And Alcoa starts this week later, but then we're still in that sort of disappointment period, or potential disappointment period. So we're in a bit of a soft spot, particularly coming after a really, really strong September. It doesn't surprise us if we get a little bit of weakness in the market for a few weeks.
Hey, Jamie, it's Dominic here again. One of the questions that we had is, for a lot of guests out is this idea that earnings are going to be the next catalyst out there. But we saw another catalyst, or a potential catalyst today, in a down market. Sara Lee up huge because of buyout rumors, leveraged buyout rumors again, possibly two parties interested with failed talks. Is that going to be contributing to some of this upside volatility, maybe a spark, if you will, for people to kind of get this M&A machine going again?
I think that could definitely contribute to it. And also with the jobs number coming up, we had a 10% up move in September. It's hard to imagine there's too much more upside there without jobs and earnings really improving the picture going forward.
Well, that sort of suggests that maybe this thing has run out of steam. I mean, are you guys buying puts down in the pits?
Well, there's a lot of volatility, and people are pricing that in going forward. We're moving at about a 16 vol right now. That's 1% a day in the S&P 500. Heading into the next year, all of the VIX futures are over 30. 30 is the amount of volatility we realized in May, which was our rockiest month of the year. So people are pricing that as a long-term level right now, which is very concerning.
Michael, I want to get back to the question of estimates for just a second here.
Sure.
Here at Bloomberg, typically, we give the consensus estimate for the S&P 500. For the past 6 quarters, companies have beat estimates at a rate of 70% or better. Before that, we were running at about 2/3. Do you think it's a question of companies really just outperforming by that much, or do you think it's more of a structural issue with the Wall Street estimates that people are just sort of now continually underestimating?
Well, I think it is a bit of a structural problem. There are, people don't want to get bagged, so they intentionally keep the numbers low. A lot of companies talk down estimates so that they can exceed expectations. I mean, I think there's some structural issues there. Again, I think the issue is, have Wall Street estimates and analysts finally caught up with actually what's going on in corporate America generally? There's a lot of cash in corporate America right now. There's a lot of very strong profits, and what we've seen is not necessarily a reinvestment in people, but a reinvestment in capital. As there are 3 basic things companies can do with their money when they have a lot of it. 1 is to pay dividends, 2 is to buy shares back, and 3 is to do M&A. And we're seeing all 3 of those in pretty significant ways.
Hey, Jamie, since we're going back to things, you originally said that you don't think low volume is a sign of negative sentiment. How could it not be, really, unless maybe a lot of investors bought and are holding? I mean, do you think that that's what happened? Or do you think that the low volume really means that just in general investors don't trust the equities markets?
I think in the age of high-frequency trading, volume is really more a function of volatility, and the trades you're seeing are not, pension funds going in buying 500,000 shares. More of the volume is really just on the back and forth these days. So what I've been seeing in September is not necessarily a negative indicator, just because we are moving slowly upwards and there's less need to trade back and forth.
Hey, Michael Vogelzang, let me jump in here. Have we gotten to the point where we've effectively we're done playing games? All right, you can't bring the cost line down anymore. All right, so you got to have the sales coming through the door. If things are slowing, are we bumping up against a point at which CFO can't make the earnings look the way he wants to? You got to actually have the numbers, and we might not be there.
People have been saying that for the last 3 quarters, and so there's differentials here between those companies that see revenue from overseas, companies that are seeing that have significant revenues from overseas. I do believe actually will show up with decent revenues coming forward, particularly those from the emerging markets. I think purely domestic plays are going to be a little tougher to beat revenue estimates. And look, we all pay attention to not only did they beat earnings this quarter, but what are they guiding forward? And so, it's always that parlor game of understanding what expectations are versus what the company's actually telling us. And there are times when we think, hey, we've got it nailed, and the company nails it, and the stock goes down. And